From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
You're listening to Money Talk for March 6, 2026. Let's see what's happening. The Brewers continue Cactus League play in sunny, warm Arizona. Your Milwaukee Bucks are home Saturday night with the Utah Jazz and Sunday with the Orlando Magic. The Admirals welcome the San Jose Barracuda onto the ice tonight at Panther Arena. And on Saturday, getting a jump on St. Patrick's Day, it's the Shamrock Shuffle. If you have enough green beer, you'll be shuffling. Okay. Let's start down in Florida. A Sarasota man faces DUI charges after his wife flew out of their vehicle. When the cops arrived, the wife, who's going to be all right, was laying on the ground. What about the husband? Well, he was passed out, still sitting behind the wheel of their golf cart. Now he's going to have some splaining to do to a judge. In Washington state, at least one government agency allegedly no habla español. Callers to the state's licensing department who opted for service in Spanish only got an AI-generated voice, speaking in English with a strong Spanish accent. The state is looking into the problem. Finally, in Dubai, police have arrested a beggar who was found in possession of 3 luxury cars. He's being charged with manipulating public sympathy. This guy belongs in the Panhandlers Hall of Fame. Around the table today, we have Tom Pappenfus, Joel Dresang, and wrapping up the week, here's Kyle Tetting.
Well, thanks, Jason. A tough week overall for markets. NASDAQ down 1.2% this week. That's 281 points. The S&P down 1.6%. And the Dow down 453 points on Friday, 1,476 on the week. Finished the week down 3%. For the year, NASDAQ now down 3.6%, the S&P down 1.5%, and the Dow Jones Industrial Average down 1%, all including dividends. Tom, hard not to look at the ongoing war in Iran and pretty quickly point to that as the reason for the massive sell-off this week. It was a pretty steep and swift decline. I think talking in the podcast last week or even going back a few, not a lot of clarity that any of this was coming near term. Certainly a lot of conversation around what we would do with Iran and how we might resolve these issues. But it very much appears, at least for now, like we're in the midst of some kind of conflict that's going to draw our attention for some time. And certainly investors have not responded favorably to that news.
Yeah, obviously a big shock to us and a lot of people out there. And hence from those shocks that you can't really predict or see, leads to just how much of a drastic hit they have on the markets and, not only domestically but globally. And I think the biggest reason naturally is to the expected price of oil. A barrel of oil, I think, jumping roughly 50%, if you'd say. I think we're hovering around $60 a barrel, now approaching $90 a barrel. And that is something that affects companies worldwide, globally. And you kind of look at the nature of that impact. We can see domestically markets sold off quite a bit here, but globally even in a much greater magnitude. You kind of look at the proximity as far as the reasoning behind why you might see something like that. As a lot of people know, but we are largely energy independent. We don't rely too much on Middle Eastern oil, but you look at other developed parts of the world, Europe, Asia, and anything in closer proximity to the Middle East, they are far more dependent on that. So those global markets sold off far worse than we have seen, which is unfortunate, especially considering a lot of our investors had seen really strong returns in international markets here to start the year. And we're kind of, talked a lot about rotation happening in markets of late, the way this year has started. Some of these influences and factors are rotating it back, oddly enough. So we're really in a big state of, I think, still shock in these markets, still a lot of fog and a lot of uncertainty if we weren't already experiencing that. And generally, you kind of want to just sit tight to see kind of how this continues to unfold.
I think it's important to point out that 20% of the world's liquid petroleum passes through the Strait of Hormuz. For those of you that might be looking at your maps right now, that's right along the coast of Iran. There is no way around for 20% of the world's energy There's no way around it. And now you have insurers coming out and saying they're unwilling to insure maritime shipping through that. You have any number of shipping companies that are saying, yeah, we can't risk this right now. U.S. government stepped in. The Navy has said they'll escort those ships through the strait. You've got all kinds of assurances, I think, from the government that, yeah, we're going to make this all right. And yet it does appear, at least for now, like the market's not quite taking that in stride. And I don't blame them. There's plenty of concern when we look at the near-term consequences of this conflict. The challenge, of course, is that it would seem to be in our best interest to resolve this fairly quickly. Of course, you have a much bigger conversation over other players. You have a much bigger conversation over what comes next in this conflict. And for investors, I think the longer this carries on, the more we have to pay attention to things like this massive spike in the price of oil, the more we have to pay attention to the spike in volatility that's taken place. Because the reality is that of the last 6 recessions, 3 of them were preceded by massive spikes in energy prices, that many of the bear markets that we so much want to avoid, those 20% declines in stock prices, were preceded as well by a spike in energy prices. And so it's interesting how significant energy prices can be, both as a pressure towards inflation and a detractor from economic growth. It's rare that that one thing can have both of those consequences, not only, again, slowing down growth, but also impacting inflation so drastically. But the reality is that if consumers are forced to pay more for energy, they have less to spend on everything else. And so the 2/3 of our economy that's driven by consumer spending is so meaningfully impacted by energy in a way that maybe the price of beef or sugar or whatever else might not immediately have. There just aren't good alternatives to oil. There aren't good alternatives for most to these liquid petroleum products that drive the vast majority of our everyday lives. And so I think when we look at the economic impact, it's hard to understate how significant it will be the longer this carries on. The one caveat, you mentioned our energy independence. We have not so far seen a meaningful uptick in oil rigs here in our country. But at $90 a barrel, there's a lot of reason to think that if you're a marginal manufacturer, somebody that at $60 a barrel couldn't make any money, well, at $90 a barrel, you can probably make quite a bit. And so we may see these many unused oil and gas leases in our country finally put to work. And it may mean that despite a lot of the concern that's out there about loss of life, damage to property, the bigger picture problems that come with war, that this may actually be a benefit to some of our industrials and especially our oil and gas companies.
Yeah, I think one of the biggest issues we face right now is just the uncertainty about how long this may last. I mean, I think that's the real big variable into how much damage we may see upon the economy. You can kind of break it up into what are, at least me coming across, J.P. Morgan, Morgan Stanley, about how they kind of break this scenario down into different timelines of, well, if we're in 4 to 5 weeks, 5 weeks to, perhaps 2 or 3 months, and then 3 months and beyond, and where does that really start to feel that bite? And the reality is as you talk about the higher prices and the direct impact on the bottom line through higher costs. The other part about this, and you kind of touched on already, was the impact to inflation and ultimately our interest rate or monetary policy. And that's where you're going to start to see the real, I think, longer-term impacts investors will start to look ahead. They'll start to realize, what does it mean? I think a lot of investors are always being forward-looking or looking 6 months down the road. We've gone from an 80% chance of a rate cut by June. Now it's down below 50% chance of a rate cut. For a lot of situations, markets have been pricing in, lower rates into their valuations and pricing models, and that's going to likely start to change the longer this draws out. Then we're not maybe looking at any rate cuts, and possibly on the table is rate hikes if inflation is a big concern. So we have 2 big things we're weighing here as we're fighting inflation, and possibly if there are higher costs, what does that mean to the overall economy, labor markets, and perhaps a slowdown that we may be trying to fight.
And Tom, inflation is the number one concern of consumers that we always see month after month in these surveys. And we've been saying for months and months that it's there's a split between what consumers are saying they're concerned about and what they're doing, and they've been still spending money even though they've been concerned about inflation. But we're seeing more numbers that are suggesting that consumers are cutting back more. We had numbers today on retail sales from January, and the sales actually went down for the second month in a row if you take out inflation. But even in real terms, the sales went down, and out of 13 categories for retailers, 7 of them lost money from the month before. One of the things that I followed specifically in the retail sales are bar and restaurant sales, and because I always figure that's an indicator of consumer confidence. Because if you're feeling okay about where you are with what you're earning and what you need to spend on the essentials, that you're going to go out and have a beer and a fish fry once in a while.
I thought you were going to say you're going to feel okay because you've been at the bar for a while and you feel a lot better.
There's a factor there too. but so we're actually seeing bar and restaurant sales going down, third time in 4 months. So there's a sign there that maybe we're starting to see more of the consumer cutting back because of inflation and higher gas prices. I mean, we're not seeing a whole lot, maybe, because of our energy independence. We're not going to see a whole lot of the factors from the war on that. But gas prices are already going up within the first week after the attacks on Iran, and that affects consumers' psyche.
It does, and I think the challenge we have is not to put so much emphasis on the current uncertainty and the current challenges that we forget the role that a lot of the businesses we invest in play long-term for our portfolio. And so important that we have tools to weather the near-term storm. It's why we talk about the importance of cash, the importance of balanced portfolios, because with everything else, with the things you don't need the 3 years, the 5 years, the 7 years down the road, there really still are some great opportunities out there. And Joel, one of the things we look at is how much contribution businesses have made to productivity growth and how much businesses can be more profitable because they can do more with less. And we got a productivity number this week that I think tells some of that story.
Right. The Labor Department came out with a report showing, it was a preliminary look at the productivity, that's output divided by number of hours worked. And they found that in the last year, productivity was 2.2%, which is on par with what it has been during this business cycle, which started at the end of 2019. But if you look at the business cycle before that, the 12 years before that, it was only 1.5%. And we're actually back up to what the long-term average has been since 1947. An interesting aspect of that report was that the share of output that has been accrued in compensation to workers is the lowest of all time. So going back to 1947, the workers are getting the lowest share of the economic output. It's at 53.8%. And I kind of took that two ways. One is it's not as great to be a worker as it used to be, maybe. But the other aspect of it is maybe that's a better reason for owning a company.
I think that is the perfect reason why investors need to look beyond that short term, right? That if these businesses are getting more productive, they're not passing as much of that growth along to the underlying workers, but instead passing it along to the shareholders in the form of higher profit margins. Well, Tom, we've talked for years now about the role that higher profits play in our willingness to maybe pay a little more for the stock market. But perhaps those higher earnings, those higher margins that are driven from this productivity growth are one more reason why we want to own stocks.
Yeah, we want to continue to own stocks in this market. And again, my message to clients right now is that you do want to be in this market. This is certainly not a time to be fearful. Perhaps there might be different areas of this market to be in. But one of my taglines I may overuse is just that never bet against American capitalism. We will find a way to make more money in spite of any and all circumstances. And that continues to be true. And so I do believe that, as kind of Joel mentioned in the numbers, the economic growth seems to be good, purchasing manufacturers. There's a number of good things here. There's underneath kind of the news and the headlines of the geopolitical concerns and risks, companies are profitable. We are seeing Again, good earnings growth hasn't dramatically changed. We haven't seen revisions downward yet. It's just too soon, too recent to this announcement of the Middle East conflict to really know the true impact. So you do want to stay in this market. Broad diversification is working. I get the fun news to share with clients that they are outperforming broad stock-based indexes with a dramatically less risk right now. And it's just like I said, the markets are rotating. They're rotating quickly. And a lot of times when things are moving fast, it's best to kind of stay still and wait till kind of the dust settles to see where it's the best place may be longer term.
Joel, we had a little bit more economic news this week. ISM manufacturing and service sectors numbers, maybe a bit more on the status quo side. Everything is kind of slowly growing. And then we had labor market report that maybe was a little more concerning. Seems to be the case, right? We're getting some good along with some bad still. And hard to see exactly how it shifts, but at least the ISM numbers gave us a little bit of hope that things are still growing slowly.
Right. Yeah, the service sector, which is the biggest part of the economy, was growing at the fastest pace since July of 2022. So that's doing pretty well. The manufacturing side, however, it reported an expansion for the second month in a row, but it's getting slower. It's slowing down. And as far as the labor numbers, we had the jobs report today from the Bureau of Labor Statistics, which looks at unemployment, and that's kind of where it has been for a while. It ticked up a little. It's at 4.4%. Historically, that's still a pretty good number as far as people out of work and not being able to find a job. But there was, I found, as I always do, I found mixed signals. A couple of good things were that the prime age labor force participation, so those are people who either are working or looking for work, that is now at a record high, and that's pretty cool. Or it's near one. It's reached a record in January, and the February numbers were off, but just a little bit. The other thing is that wages on a year-to-year basis continue to outpace inflation, and that's good. Because as we were talking before, 2/3 of the economy is driven by consumer spending. So you want consumers to have more money. And even though they might not be getting as much of the output of the economic output, as long as they still have money to spend, that's a good thing. On the flip side of the employment picture is a couple of things that I look at is the U6 rate, which is sort of an underemployment rate number. And that's been at it's been above the pre-pandemic level now for more than 2 years. So that's not a good sign. Another thing that I look at, though, is temporary employment. So people who are in temporary staffing jobs, that usually is considered a harbinger of the trends in the market of whether we're creating more jobs or whether we're about to start cutting more jobs. And actually, we cut jobs in February for the second time in 3 months. And it could be even more than that, but we don't have data from September, from October and November. But the temporary help employment, if you set aside the aberration of the COVID pandemic, that number of temporary staff help is 23% down from its peak in 2022. It's at its lowest level since 2012. So that's a while.
It's been an interesting journey for the labor market, especially the recovery from the COVID pandemic, where we realized we could do more with less in some cases. We realized the kinds of talent that we needed looked different, had different skills, and I think the economy is still recovering from some of those lessons. But at least this week, the economic news painting a still mixed picture, not reflecting at all kind of the current concerns. And I think that's part of the challenge now, is that we need to continue to keep a pretty close eye on how those economic indicators evolve with respect to what we're currently seeing in Iran. I would add that this is also a pretty interesting time for clients looking to access their accounts, and that we have a new way for them to do that. Many of you have already been into the new Orion web portal. But I suspect that with all of the volatility this week and with the potential for more as we look ahead, that more and more of you are going to want to check on your balances, on your performance. This new portal from Orion provides a wonderful way to do that, and I'd encourage you to reach out to your teams if you are a client of ours, and we're more than happy to help get you set up and get you access into that system. With that, we enjoy doing the program for you. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.